Hello friends, welcome to The Financial Prophet. I have a very special show for you today. We're going to discuss the recently started rolling correction, the abysmal jobs numbers, the Fed, and how all of these fluid elements can impact our favorite stocks. Wow, did you see the recent jobs numbers? Much to the market's surprise, July's non-farm payrolls report illustrated that the jobs market is in much worse shape than previously anticipated. Much of the recent optimism in the market was centered around the thesis that the economy was essentially firing on all cylinders. Well, the 31% miss in the recent non-farm payrolls report throws a huge monkey wrench into that assessment. Moreover, it's not just last month that was bad in the jobs market. Massive revisions were made for the previous 2 months as well. I was highly skeptical concerning the accuracy of June's numbers, as it did not make sense for the non-farm payrolls to come in at 147,000 versus the 111,000 estimate, especially given that the private non-farm payrolls came in at only about 74,000, missing the mark by about 30%. How did the government create so many more jobs than anticipated, I wondered? Well, it appears that it didn't. Instead, the numbers were, quote, flawed. June's jobs numbers got revised down massively, implying that the economy only created about 19,000 jobs in the whole month. This dynamic also suggests that private non-farm likely came in negative, which is a very troubling signal for the broader economy. May's number also got revised substantially lower to only about 14,000. Further illustrating the considerable trouble that the jobs market is in right now. Given this trend, it's likely that July's numbers could be revised lower as well, potentially illustrating contraction in the labor market, especially concerning private sector jobs. Meanwhile, stocks, they keep rushing higher. We actually witnessed a bit of a blow-off top in the market to start the month. We also noticed peak greed and optimism occurred in early July. Moreover, many of the high alpha momentum stocks began correcting around mid-July, which implies that the broader market could pull back more in the coming weeks. The Fed just keeps looking the other way. The Fed continues focusing on inflation despite its dual mandate for maximum employment and price stability. Granted, some recent inflation readings have been warmer than expected. The recent CPI came in at 2.7% instead of the expected 2.6%. The core PCE also came in quote hot at 2.8% instead of the anticipated 2.7%. The core PCE is likely the number that the Fed watches closest, as this is the number the Fed refers to when discussing its 2% inflation target rate. Unfortunately, the PCE has been going in the opposite direction, which is potentially why the Fed has not reduced rates yet. Well, I have two primary questions here. Number one, is the Fed too late? My first question, it's pretty obvious. It's whether the Fed is too late to the party. The jobs market appears considerably worse than expected, and easing in September may be too late to save the economy from a considerable downturn. Arguably, the Fed should have been cutting rates in the anticipation of the jobs market slowdown. It would be much more constructive if rates were about 100 basis points lower right now, in my view. Now, my second question is a bit more complicated. Is the market too optimistic regarding the September rate cut? It would seem almost a no-brainer that the Fed would cut rates in September given the poor performance of the labor market. However, is a cut in September really guaranteed? After all, we've witnessed the Fed chair being very focused on inflation and constantly highlighting the resilience of the jobs market at the same time. Inflation remains high by the Fed's standards, and the central bank could continue focusing on bringing inflation down before beginning to cut rates again. Personally, I believe the Fed will likely cut by 25 basis points in September, just because how poor the recent jobs numbers were. Nonetheless, I don't believe that there is a 90% probability as the market seems to suggest here. The odds could be about 60-40. in favor of a rate cut in September, in my view. Therefore, the market may be overly optimistic about rate cuts now. Also, there's still a lot of time until September's FOMC meeting, about 5 weeks. A lot could happen between now and then, and the uncertainty regarding the jobs market, inflation, future growth, and the probabilities for a rate cut could lead to increased volatility leading up to and into the September FOMC event. Let's see what Truflation is telling us. Currently, Truflation illustrates inflation well below 2%, and I trust Truflation's figures much more than I do the government statistics. First off, Truflation is a real-time, non-government, independent inflation gauge. Moreover, Truflation illustrates inflation in a more real-time dynamic as opposed to the PCE CPI showing a more lagging image of inflation. So basically what Truflation is showing us here is that the Fed could be behind the curve and we could be actually approaching a level of possible deflation soon, which is something that the market could fear the most. So the Fed needs to start acting, and it needs to get its act together quickly before the market heads south, potentially in a big way, if the Fed doesn't cut in September or is considerably hawkish instead of turning more dovish before the September FOMC event. So the bottom line is that inflation may already be well below 2%. In fact, if the US inflation gauges excluded housing inflation, much like the European inflation gauges do, the core PCE would be around 2% or lower right now. Paradoxically, if the Fed considered inflation like the ECB does, we would likely already have substantially lower rates in the US right now. Unfortunately, we're looking at a deteriorating labor market that may lead to a more considerable economic slowdown. Due to this dynamic, we may witness increased volatility in equities in the near term. The market remains around all-time highs, don't forget that, and may still need to adjust to the new economic reality, which increases the probability for a pullback in the coming weeks and potentially even months. And the new economic reality that I am referring to here is that in the near term, there's basically more uncertainty about the labor market, about what the Fed is going to do, and about the growth trajectory in the US economy in general. So while I remain optimistic on the US economy, and I'm keeping my year-end S&P target around 7,000, I do believe that the market could correct more in future weeks, potentially reaching the 6,000 level in the S&P 500 before the next move higher begins in the fall. So having said all that, my 5-point pullback plan, it remains in place. So let's go over it again. Number 1, decrease risk. I've taken profits in numerous high-flying stocks recently, and I may take more short-term profits and decrease more risk as we advance. Number 2, increase cash dry powder holdings. I've taken 25 to 50% profits in many high-flying equities that I had in my, and I still have in my all-weather portfolio. Also, I have access to margin just in case a considerable buying opportunity occurs. If you're not potentially implementing margin, or if you just want to stay on the safer side of the equation, you could increase your cash position to 5 to 10% if your risk level is moderate. Now, if you have a lower risk tolerance, you could even potentially increase your dry powder cash position to 15 to 20% here in my view. Number 3, continue to rotate. I have continued to rotate away from higher alpha tech and some more speculative stocks and sectors. Instead, I've rotated capital over to more gold and silver, industrials, materials, defense, oil and gas, pharmaceuticals, biotech, and other stocks that could better withstand a pullback or a correction and may even move higher if the broader market declines. Number 4, increase hedges. I have implemented some covered calls and put option hedges, some collars as well, and I may also increase put option and other hedges in the near term. Number 5, capitalize on the potential downside. We have options, we have inverse ETFs, We have other short-term trading vehicles at our disposal that we can use to capitalize on potential sector or even broad market rotation or downturns in the near term. I want to thank you very much for watching my profit report. I truly hope you enjoyed it. And more importantly, I hope that the knowledge you gain here helps you make more informed decisions in the future. I would also greatly appreciate hearing your comments, so please join the conversation in the comment section below. If you enjoyed my video, please click like, share, and subscribe to my channel so I can continue creating these highly informative and potentially very profitable videos for you. You can also join the Financial Profit, my exclusive investment community, which is seeking alpha's #1 service for proven portfolio profits. So don't hesitate to join our incredible investment community now. Thank you very much for watching. See you next time and have an amazing day.